Thank you very much for participating in another AQVA webinar, this time organized together with Citibank, one of the main banks with whom we work abroad. It is a pleasure to have with us Matthias Reichersdorfer. Matthias is the team leader of the investment counselor and is responsible for the investment platform for Citi Private Bank Brazil. He has over 25 years of experience in the financial industry, starting as a manager, then institutional sales, and for the past 12 years working in private banking. It is also joining us today Gustavo Faria Lima. Gustavo is the Senior Investment Lead Analyst for Brazil and a Vice President for the Latin America Investment Lab. He is based in Miami and responsible for advising mega wealth and ultra high net worth clients in Brazil and the US. We are approaching the end of the year, certainly a year that has been very special. COVID-19 has left 1.5 million deaths to date, and the biggest falls in the economy not seen since World War II. Financial markets experience a roller coaster, having the fastest drop in history and a very strong rebound, explained mainly by the help of coordinated action by central banks and governments around the world. In the last months, several laboratories have made very positive progress with the development of vaccines, which sheds a light of hope so that in the coming year, we can return to some normality of our lives. Expect for next year and how to position our portfolios. So we have two parts in this webinar. In the first part, the idea is that Gustavo will tell us an analysis of the power and importance of staying invested. And in the second part, Matthias will tell us the Citibank market outlook and what is the view for next year. So please, everybody, feel free to send any question during the webinar that I will read them after each part of the presentation. So after this introduction, I will give the floor to Gustavo to start the presentation. Thank you very much, Gustavo.
Thank you so much, Ismael, for the great introduction. Good morning and good afternoon, everyone. Hope you all are doing well. If you can just bear with me for 1 second, I'm going to be sharing my screen for today's presentation. So as Ismael mentioned, my name is Gustavo. I work for the Investment Lab for Citibank. I've been with the bank for the last 6 years and for the last 2 with Citi Private Bank. Today, we're going to be talking about the power of staying invested. That's an analysis or study that we did for 2 years now. We've been updating since then as facts evolve. We're going to start with what we call at Citi an efficient portfolio. It's a moderate portfolio. Our portfolios go from 1 to 5. This is a level 3. It's right in the middle with hedge funds and private equity real estate. It's one of the pillars that we have in the Investment Lab out of 3, which one is diversification, not only in terms of asset classes, but also in terms of sectors and regions too. So we're going to use this example throughout the presentation. You can see here that we have almost 60, 67%, 42, 43% in terms of equities, 40% in terms of fixed income, 10% hedge funds, and then 10% of private equity real estate. So I did a recap about COVID, which is a very unfortunate pandemic, which is still going on. And we decided to update this slide here. On the right side, we have a couple of regions versus global returns during those crises. And we just updated the last row here for the COVID pandemic. And here we're trying to make 2 arguments. On the left is, as the name of the presentation suggests, the power of staying invested. So we can see from years 1 to 10, the longer that we stay invested, the less we can see in terms of volatility. Year 1, it ranges from minus 31% approximately to 44%. And as we move from 1 year to 3 year cumulative returns, 5 years, and then 10 years, we basically end up with only positive volatilities. We go from 4% to 19%. And again, that's in reference to that same CPB or Citi Private Bank reference portfolio, level 3 that we mentioned with hedge funds and private equity real estate. On the right side, we try to put some real numbers going through a crisis that unfortunately we all had to go through. So in Asia, 1997, we saw that in the region, the return for equities was minus 30% approximately, globally 15%. Latin 98, minus 35 versus 22 globally. Eurozone 2011 to 2013, minus 10 versus minus 7 globally. Commodities collapsed in 2015, minus 31% for Latin, minus 2 if we round it up for global. So those are big differences. And we look at the pandemic, and the returns here up to January 1st up until June 30th. Brazil was down almost 40%, and globally minus 6.6. So those are big differences, big returns. And the argument again is diversification in terms of region on the right side, and staying invested. Don't try to time the market because percent of the time, at least I wouldn't be working right now. And we're going to make the strong argument for that comparing with different probabilities. Now, on the next slide, we're seeing, and I think that's a really truthful statement that at least I can assert for Brazil, how quote unquote easy it was to get returns back in the days with fixed income and Selic, where we had double digits. And now we're seeing it at lowest levels ever seen before. So the argument here is in 1995, if we look at the returns that Citi Private Bank had, estimates returns of volatility, 1995, fixed income, just one asset class, the return would be give or take 6.5 with a volatility of 4.4. Now we fast forward 25 years on that. Let's see what are the expectations from Citibank for the same single asset class. Let's round it up to 2, standard deviation of 4. So that's 3 times less than what it had 25 years ago. Okay, let's try to get that same moderate portfolio that I initially spoke about, level 3 with hedge funds and 10% private equity real estate. We're still far. Estimated return for that would be a 5.1% and volatility more than double. Now, to get to the return that we're expecting 25 years ago, again, to be very redundant with fixed income, to the 8.2, we more than quadruple the volatility that we have. We go from 4.4% to 18.8%. And most importantly, at least for my view, is we are in the highest or the riskiest portfolio that we've seen, the model that we have, which is a level 5 with hedge funds and 30% private equity real estate. Now, continuing with the same argument in terms of single classes versus multiple asset classes or diversification, we're going to get an asset class which has done, in theory, well for the past years, or that most of our clients usually have a preference for, which is equities, right? So here what we're doing, we're getting the last 65 years. We go all the way back to July 1955. We're using 5-year rolling historical returns. And you can see, if you can take one outcome of the sliders in the graph that we're looking at, is when we look at the returns, there are at least 6 to 7 periods with negative returns. And that's going to be important, or I'm going to be highlighting on the next slide. So here we have equities, average return 12.4 in the last 65 years with a volatility of 6.7%. Okay, but that's not fair because they're using just one asset class. You are getting, to some extent, compensated for the volatility that, or the risk that you're going for with a 12.4 return for equities, right? Okay, so let's make this more of a fair game and use a 60-40 portfolio, which we've seen a couple of clients do too. Same deal, last 65 years. First thing that we can notice, if you haven't noticed yet, is when we look at the blue, dark blue that's filling all of the returns on the graph, now we can only see one period of negative return. I'm going to highlight this here. That's on the 2008 global financial crisis that we all seen how it happened and what happened. Most importantly, if you remember, you have a diversified portfolio. Your return is now 10%, but your volatility went down from 6.7 to 4.5. And if you do remember, on the previous slide, we had around 5 to 7 periods of negative returns, all on a 5-year rolling historical average. And now we only see that happening in 2008. Now, to make it more interesting, we go to the Model 3, Level 3 portfolio with hedge funds and 10% private equity real estate. Now, first thing that I'd like you to notice, once again, as we look at the returns on the dark blue filled out expected returns on the graph, there's absolutely no negative periods when we look from July 1955 to July 2020. In addition to that, we are really close to the return that we had with equities. If you do remember, and I'm going to go back to it, 12.4, and the volatility is more than 2%. Expected volatility is more than 2% lower than we only had with all equities portfolio. And this is not to mention if we add in the alpha that can be generated by managers. Now from 11.7 return from the equities portfolio, now we can see an 11.6, and again, with more than 2% less volatility for that time frame. Now, I made a joke initially in terms of if we could all time the market 100% of the time, at least I wouldn't be here. And we can see this pretty clear, or the probability of that happening pretty clear, I should say, on this slide. The sizes of the spheres that we're looking right now, they're proportionate to the probability of that event happening. So we start from the outside to the inside. We look at the gray sphere, the largest one, and that is initially the probability of giving birth to identical twins. That's 1 over 250, that's 0.04%. Now, if we go from the outwards into the inwards, the next one would be winning a gold medal. Oh, I'm sorry, would be scoring a hole-in-one in golf, which I've seen a couple of videos myself, but I've never done one. Then most amazingly, winning a gold medal. Last but not least, winning the Mega Million. The most curious one is being struck by lightning 4 times. And last but not least, to our point, perfectly guessing the 10 best days in a decade. So out of 300, out of 3,650 days, perfectly guessing the 10 best days during that time frame. And it's less than 1% of computer pixel, which we cannot even describe it, or we cannot even see it on the screen. So that's how low that probability is. And why am I talking about the 10 best days? Because for the next slides, the analysis that we did will be considering the 10 best days, the 10 worst days, and then following on to increase a little bit the sample that we're looking at, the 20 best days and the 20 worst days. Now, this is a slide that I like to use, especially when I'm presenting in audiences, because if you have to understand just one thing about this slide, and I usually ask the audience, what do they think it's related to? We have highlighted a period or a couple of months in 2008. And while we can see that, and everyone would say, oh, it's a global financial crisis, it's correct. But most surprisingly to us, what we found, we're looking at different decades. That includes 2020 to 2010, 2010 to 2000, and so on and so forth. we notice that those in blue are a couple of the best days out of the 10 best days of a decade. So here we're showing 8 days out of those 10 best days. And you can see that they're really clustered together. Now, not surprisingly, those days are clustered also with some of the decade's worst 10 days. So that's pretty compelling, and we can see that as we saw in March, and as we've seen it on the Christmas present that we got 2018, December 24th, when the market went down and recovered in the upcoming 2 to 3 months. So what we're looking at here is 4 months out of 2008, out of the decade from 2018 to 2008. The 4-month return with those best days is minus 27%. Which you look at it and say, well, that's really bad. It's double digits, it's going down. Well, if you take out the 10 best days from minus 27, you go to minus 58%. So trying to guess those days, as we've seen in the previous slides, it's almost impossible 100% of the time. And even worse, if when the market is going down and you have no lead for liquidity, there's nothing coming up in terms of an event that will require that money, or the fundamentals of the companies that you invested are still there. You don't believe they're going to go bankrupt. Stay invested, and we show that with a couple of examples going forward. In the past has been the best option, and we simulate a couple of scenarios regarding how we should proceed in terms of staying invested, switching to a less risky portfolio, or even double dipping. Now, you say 2008 is not fair. Let's see how that looks for 2020. So we updated, same analysis, and that's the S&P 500 return. That's the one we'll be talking about on the previous 2 slides. So now we have data up into June, and you can see that the same phenomenon happens. And it happens, I can tell you, because I've done that a couple of times for the last 4 decades at least. Again, we have some of the 10 best days in a decade clustered with some of the 10 worst days in a decade. And here it's even more compelling, because when we look at it, and we just experienced that, we're talking about a 1% return from March to June. And if we exclude some of those 10 best days, and here I believe we have 7 of them, it goes to minus 33. So you go from almost a break even to a 1% return to minus 33%. I at least think that's pretty impressive. Now you might say, Slava, that's not fair. We're looking at the last 2 decades. There are a lot of crises in there. Let's exclude those. But reality is, with the analysis that I've done, the different analysis that I've seen, we, at least that I recall in our models, we have anywhere between 15 to 20 crises. So it's pretty hard to find a decade that something or a phenomenon didn't happen that resulted in a correction. But to try to showcase that, we took a look at the last 4 decades. And here, we're looking at the top 10 days. On the next slide, we're going to be looking at the top 20 days to see how worse it can become. So you can see that from 2011 to 2020, you go from a positive 12% return on the S&P to a 5.2 if you exclude those top 10 days. 2008 to 2017, 8.5 to 1.3. And you can follow on the rationale, right? 98 to 07, 6% to 1, 88 to 97. Good times of double-digit returns, 17.6% to 13.9. So literally what we can see between the dark blue bars and the light cyan, or the light blue, is the money that, or the opportunity cost of trying to time the market, which here, it goes from minus 7.2% to minus 3.7%. Now, those are just the top 10 days. If we add the top 20 days out of 3,650 days, this is what we get. Basically, out of the last 4 decades, we're looking at 2 decades where we go from positive returns to negative returns. If we look at 2011 to 2020, the most recent one that we can remember, we're going from double digits, 12%, to 1.4. That's an opportunity cost of approximately 11%. Same thing with 2008, 2017, 11%. Almost the same thing, 98 to 07, 8.5%. Leave it left on the table. And from 88 to 97, 6.6%. Now, I had mentioned an analysis or a simulation that we did in terms of crisis, all the 15, 20 crises that we have in our models and the ones that we use. And to exemplify that, or to put into concrete numbers, we did a simulation. So we're gonna have, again, a reference portfolio, an efficient reference portfolio. Now we're gonna scale up. We're gonna use a level 4, which is the previous level from our highest, which is a level 5. And it's also going to be diversified. So that's a portfolio with 72% equities, 14% fixed income, and 14% of hedge funds. And we're going to have, it's a level 4 portfolio, and we're going to use those last 5 major crises that we've seen. What happened here in this simulation, we have this level 4 portfolio. The market is down 10%. On our hypothetical crisis, and having a choice to be made. So that's month 4, markets are down 10%. We can go 3 ways. And that's why we increased to a level 4, so we could reduce it to a lower level in terms of risk and returns for this analysis. So we start with a level 4. We can either reduce the risk to a level 2, we can buy the dip, and it's down 20%, or we can stay invested. So that's, again, a fun part when I present this to an audience on a live environment where, by show of hands, we ask them to which option they would go for. And usually, most people go for the reducing the level of risk of the portfolio. Now, here's the interesting part. So month 4, investors are scared, markets are down 10%. We have our diversified portfolio, and now we're showcasing 3 scenarios, right? We move from a level 4 to a level 2, so we're potentially reducing the risk of level on that portfolio. Then 4 months through the crisis, that portfolio is down 13%. It seems like a good choice when we look at our friends who stay invested, who are now down 19%, and our other friends who bought the dip, they're down 21%, almost double our portfolio, right? The returns that we're having. Now we fast forward 13 months within the crisis. So that's month 17, right in the middle of the slide. You're slightly happy because the portfolio from minus 13 probably is now minus 2. The buy the dip, or the group who bought the dip, from a last position 9 months ago, it's already in first position. He already broke even. He's back at 0%. And we have the stay invested pretty close to the level 2, the one who reduced risk. Now, that's to say that the buying the dip got to the break even first than the other 2 portfolios just in 9 months. Now we fast forward to month 26. The buy the dip portfolio is up 10%. The stay invested probably around 8 or 7. Oh, pardon, 5, more like 5%. And the one who reduced risk, which initially we thought was a good idea, is now around 2 or 3%. We fast forward 2 months. We're now month 28 within the crisis. The buy the dip portfolio is at 15%. The stay invested portfolio is now at 10. So it took them, which is also a good option, but it took them 2 months, an extra 2 months to get to where the buy the dip portfolio was, to the same 10%. And unfortunately, the portfolio that had, which seemed a good idea to reduce the risk, is now probably around 6 to 7%. Now, most amazingly, when we get to the end of month 34, so 30 months within the crisis, 2 years and change, that's when we see the lower risk portfolio, the one that will switch from level 4 to level 2, getting to those same 10% that the buy the dip portfolio had on month 26. So 8 months later, the lower risk portfolio gets that 10%. The stay invested is up 16%. And who would guess the buy the dip is up 22%. Now, if you can remember something from what I explained or presented today, I know it's a lot of information, but it would be 3 things. First one is ride the wave, which is stay invested. Don't try to time the market. We just saw an analysis that we did going for different crises where buy the dip and stay invested generally outperform the lower risk profile, which is sometimes counterintuitive. Definitely, we saw with the different spheres winning gold medals, winning the Mega Million, holding one, giving birth to identical twins. Probabilities are definitely not in our favor when trying to time the market. And last but not least, the opportunity cost of trying to time the market is significant, as we've seen for the last 4 decades, excluding the 20 best days. So that's 20 days out of, again, 3,650 days. For 2 out of those 4 decades, we go to negative returns. And the other 2, we leave on the table anywhere between 5 to 7%. Now, this is a thought prerogative slide, which is also known as the QOT. And I like to share it with Brazilian clients because being born in Brazil too, it was always quote unquote easy to invest and get double-digit returns with the interest rate that we had 10, 20, 30 years ago. And there's also a belief about the equity market, which would be also giving good returns, the Ibovespa. So what I did here, and it's kind of on purpose, the numbers are tiny and you cannot see that much, because what I wanted to ideally observe is that we go from left to right. We're showcasing different indexes or asset classes from 2009 to 2019. And what I wanted to notice is that we have different colors for each of those asset classes. And not once has the same index or asset class repeated on the top position as a top performer in terms of return for that year. So there's not 2 of the same blues year by year, not 2 of the light greens. Well, you probably got the idea. Now, most importantly, when we're talking about the Ibovespa and the myth that we're trying to also break, from 2011 to 2015, we can see the MSCI Brazil with negative returns and in last place. That's 5 years of consecutive scoring last in terms of returns, or you compare it to emerging market, hard currency, developed government, fixed income, global equities. Third and last point is that slight kind of grayish beige asset class that you see. You have a 730 Brazilian portfolio too. So we try to showcase and make it more customized for Brazilians who have fixed income and equities. And if we look at that 730 Brazilian portfolio, the cumulative returns, it's previous last for those 10 years that we looked at. Before the previous slide, that's again the MSCI Brazil. And not surprisingly, when we look at the middle, an asset allocation of diversified portfolio, it's right there where it should be. Give you global returns, moderate level between expected returns of 4 to 5% year per year.
Okay. Sorry, Gustavo, the 70-30% portfolio, how is the composition? Is 70% Brazilian assets and 30% offshore?
They're all Brazilian, Ismael. That's a good question. Let me go back to it. Let me showcase it a little bit more. It's a Brazilian portfolio, so we're using the MSCI Brazil and the Barclays FI index.
Okay. So 70% Brazil and 30% US equity or world equity.
70% FI, 30% equities.
Okay.
Sorry if that wasn't clear.
Okay, great. Okay, Gustavo, thank you very much for the presentation. I think that the message is very clear, and main this year, right, with this the falls that we have in markets. So the importance of stay invested, I think, is something that we have to have in mind in March, when we have the big crash of the stocks. Obviously, some clients call to us asking if it's a good time to go out of markets, and I think that this presentation shows very clear that it's not the right moment to go out. And on the other side, trying to time the market, finding to buy in the best days of the market, it's almost impossible, as you explained, and the cost of opportunity of doing that is really big. So thank you very much, Gustavo, for the presentation.
For you as well.
Okay, now we're going to change to Matias. Hello, Matias, and well, the floor is yours. I hope we can solve the audio issues, and please let us know about the market outlook of Citi. Hello, Matias.
Okay, great. So it's funny. I guess we've all resorted to Zoom, and Zoom is sort of a fickle animal every once in a while. But Ismail, thank you, and thank you for the opportunity to be able to speak with you and your clients and some of your prospects. So as Ismail probably said at the very beginning, I'm responsible for the investments platform for
I believe you need to be on mute, Smile.
came after March, and that we were working through at that time, and that we'd like to share. I think when we look at that time and we look at how violent and how extreme all of the market moves were, I think it's very easy for us to go back now and say, okay, everybody should have kept their head calm, and everybody should have stayed and held on to the positions, and everything would have recovered. But as the empirical evidence shows, and this is actually something that we communicated to our clients throughout the whole process, the right decision at that time was to stay invested. And interestingly enough, because of what happened at that time, there have been several new opportunities that have been created. And we'd like to share a little bit of what we think for the market as it stands now and going forward. So usually at this time of the year, we share what's called our investment outlook. I'll share a little bit of themes. The publication isn't ready yet, but I'll share a little bit of what it is that we are thinking. And I just want to make sure, Ismail, can you see my screen?
Yes, I can see it. Perfect.
Oh, okay, perfect. So at Citi, we always have great names for all of our presentations. So past the election, now for the injection, I guess the big theme now, and it's quite interesting as things trickle down, is what's going to happen now that an array of different vaccines have been announced. And quite honestly, I don't think there's ever been a time, and when we go through it, more important, possibly in the history of the last couple of hundred years, where number one, this is probably the largest mass experiment that there'll ever be outside of cell phones and Wi-Fi technology. But number two, where all of humanity and society has come together in a very quick way to try to resolve a common problem. Obviously taking apart, and forgetting a little bit some extreme situations, but no borders, no time zones, no limits. Everybody trying to get a solution in hand. So this calendar is a little bit out of date. It's 2 weeks old, so a lot has happened in those 2 weeks. But the most important of which is that yesterday, as everybody saw, the Pfizer-BioNTech was approved for first use in the UK, and now today it was announced that 170,000, 180,000 doses will be shipped to New York to start being administered within or after the week of December 15th. Now, a lot, and again, maybe just stating the obvious, a lot is based on the vaccines. A lot is based on the perception of what will happen once the vaccines get administered. A lot of the market reaction and a lot of the market optimism is exactly around us now having a light at the end of the tunnel, and us understanding that what is affected the world is basically close to or has a foreseeable end. And what will the reactions be, and where do we see some of the opportunities in the market? I look at this graph, these two graphs, and very, very interesting. Obviously, when we see what has happened with a lot of the companies, and we know that demand basically fell away for a large portion of industry for a couple of months because of some of the shutdowns. As things normalize and as things flush out, you see that the demand and the repressed demand comes back fairly quickly. When we look at China over here, we're looking at levels in terms of airline passengers. So how many people are taking a plane to go somewhere, wherever it is, short trips, long trips, and we're at levels that are almost pre-COVID, right? So it's not as if we were coming out of a economic crisis or a bubble or some sort of non-exogenous event like we did, 2 or 3 times over the last several years, where we went in with unsound financials, unsound companies, and some sort of dilemma or distress that was systematic. We're absolutely not at that point. So the China story and the China rebound, very, very significant in terms of empirical evidence, what we think will cascade throughout the rest of the market and rest of the equity story. The airline one is always a good one because obviously what's most been affected, and I'll show that number in a little bit, is anything that comes in tow related to the consumer, related to anything that'll happen, tourism and some of the service industry. The U.S. has been a little shyer. And that's just because, all sorts of travel restrictions, and also not the travel restrictions in itself, but also the fact that, there's been a lot less also in terms of offer for travel. So a lot of airlines closing routes, a lot of airlines adjusting routes, giving up slots, a lot less planes in the sky. I mean, I could tell you that, when at night in New York City, driving into or leaving, before pre-COVID, you'd see the planes lined up in the sky to land at LaGuardia Airport. And today, if I see a plane or two, it's very exciting. So there's really nothing going on yet, but it'll come back. The unemployment number, and today there was another very interesting number that came out. Again, unemployment was about 60,000 lower than expected. Very important, obviously. And what's important about the unemployment numbers is that to the largest extent, the amount and the people that are still unfortunately unemployed and have been hit by the crisis are the lower echelon of the wage earners, right? So what does that mean? That means that, and concretely, so the 30%. The lowest 30% in income earners at one point in time were 80% of the unemployed. So what is that? That is a restaurant worker. That is someone who works in a hair salon. Someone that actually could even be an assistant at a dental clinic, and the service industry in general, the entertainment industry in general. Restaurants and things like that. So as the economy comes back and as things normalize, the absorption rate of these people back into the businesses has been fairly quick, and we believe that these numbers should normalize towards the end of the year. Now, why do we think that things normalize, even though we see that cases are coming up again? Consumption has basically been from the trough that we hit in April and May. Consumption has been fairly stable here. There's a bit of a drop off, but when we look up from where we came, there's a very, very solid path. This is now Europe, but a lot of repressed demand from back in those months, and that is really moving the needle in terms of revenue for a lot of the companies that had been impacted adversely. Now, one of the big things, and when we talk about one of our themes for the outlook, and one of the things I'd like to just mention and discuss today is the theory of mean reversion. And mean reversion doesn't mean anything else except for the equity names or the names of assets basically coming back to a point where the dispersion that happened because of whatever event in the past ceases to exist. On the onset of the crisis, and when we look here at this graph, we see that everything that was, and we call it stay at home, that you consume without actually going anywhere, those skyrocketed. On the other hand, everything that was on the other side of the basket, on the other side of the spectrum, didn't move, and those names have not moved. And we believe, and strongly so, that at some point within the next couple of months, these names in the bottom rung will have the tendency to convert, because consumption will move back. Consumption will whatever the product said. Here we look at the two baskets that we had defined on the onset of the crisis. We called them COVID defensives and COVID cyclicals. The defensives were basically tech, any sort of disruptive technology, and healthcare. And the cyclicals were everything: industrials, banks, consumer staples, those types of things. Now we see that the way that these, and maybe a little clearer than in the previous graph, the way that these have moved have been in quite the opposite direction. And we believe that there will be a convergence again. Here, a little more granular, some of the favorite names that we have: Zoom, which we love, I guess now, have no choice; Peloton, JD, Amazon, Tencent, everything to the roof. On the other side of the equation, Simon Properties is one of the biggest mall owners, for those who don't know. Carnival, obviously the cruise line. Las Vegas Sands, all of the gambling and entertainment properties in Las Vegas and also in Macau. These companies have not come back, have really suffered. So we think that there's definitely something that will bring these back to the prices and to the earnings that they were before. And when we look at these companies, and a little more specifically about earnings, we believe that most of the companies that have underperformed on the equity side should return to their 2019 earnings, the latest by the end of 2022 or the middle of 2022. So about 18 months forward. And as the equity market is forward looking, obviously, we think that clients should position themselves sooner than later. Doesn't mean that we think that clients should be selling out of these names, but we think that should be a reduction from these names into these names. Which brings me to my next point. Extremely important concept for us, in addition to the mean reversion, is the concept of financial repression. Financial repression, when we look at what's happened to fixed income over the last couple of years and what's happened to rates and how rates have been low for the vast majority of the last couple of years. And we believe that rates will remain low. We believe that clients should be getting out of fixed income to a certain extent and going into equity and living into equity exposure across the board, be it either through direct equity investing or taking advantage of some sort of equity products generating either yield through dividends and or volatility. And why do we think that? Because when we look at the past, excuse me for the scroll, and we look at what happened when interest rates were historically low, and we look at this graph right here, we see that for a period, excuse me, of 40 years, when interest rates were low, and basically the biggest point is right here, post World War II, when the government was issuing a vast amount of debt, when the government was keeping rates low because huge debt pile. Obviously, it's not in interest, excuse me, of anybody that there is a spike in rates. So we believe that going forward, at least for the foreseeable future, we will see rates to be low, and as such, any sort of material upside to be seen within fixed income market is quite limited. And because of this, we believe that clients should be putting more of their assets into the equity bucket. Excuse me for a second. Now, that all being said, on the practicality side, we understand that we cannot stay completely out of the fixed income market, but what we are suggesting is to make a substitution. And what we are suggesting is that clients should take a concerted look at their portfolios. And if their clients have been a traditionally very heavy fixed income investor, they need to evaluate what it is that their needs are in terms of cash flow and or liquidity in the short to medium term, and they need to rebalance accordingly. In terms of cash, just a quick comment there. Gustavo, he made an interesting comment that Brazilian clients are the most home biased of home biased clients that we know. What is interesting about that is that when we look at the cash holdings, Latin America is the client base that we have as a whole that seems to have the largest amount of cash or cash equivalent balances. And to Gustavo's point, we really strongly urge our clients to evaluate what it is that they need and what it is that they think they'll have in terms of necessity for reduce to a minimum what they hold in cash, because cash will put a drag on their portfolios. We understand sometimes it's more of a conviction play, but in the end, what we need to realize is that now there are ample opportunities for us to take advantage of, and cash is definitely not going to be an asset that will yield anything in the foreseeable future. The last comment I'd like to make when we think about implementation, and I don't have it on the slide here, we always talk about our unstoppable trends, and that is also part of our outlook. And our unstoppable trends are basically themes that Citi Private Bank has been sharing and exploring over the last few years, and basically identifying where we think the most movement will be it on the debt side or be it on the equity side, and where we think our clients will have the biggest chance of appreciation for their investments. And the unstoppable trends, I'd mentioned them before when we looked at what the COVID defensive basket was. So technology and disruptors is actually a trend that we've been looking at and having our clients go in for a while. So that's done extremely well. Another one is healthcare, which also coincidentally has done extremely well. Another one is looking at the changing demographic all over the world and what that means. So that also goes into not only healthcare, but also things associated with healthcare, be it health insurance and things of that nature. And then obviously we have the unstoppable trend for Asia and Asian growth. And there, I think the conversation is extremely constructive when we look at China, even though yesterday there was a bill passed in terms of trying to maybe unlist some of the Chinese companies from the U.S. exchanges because of whatever regulatory things. But we still believe that the Chinese market, maybe away from some of the large, more known names, is very attractive, very attractively priced, because the market, even though we think that is a very developed country, highly developed, there are still vast portions of the populace that are not accessing very simple things that we take for granted. As I said before, health insurance is one of them. Healthcare is another one of them. So anything on that side and that front, we also think is something extremely attractive in Asia. Ismail, I'll leave it at that. I know we're coming close to the top of the hour, but I just wanted to just reiterate the three concepts. So mean reversion, where we think that all assets will be pulled back up to the norm within the next 18 months. The financial repression concept, where we think that clients should be getting a little bit out of fixed income going into the equity piece, and looking again at our unstoppable trends going forward.
Yes,
so with that, Ismail.
Perfect. Yes, we have here three questions, Matthias. The first one is, as you said before, in the last 2 months, the markets have experienced a sector rotation from growth to value. That it means the COVID winners, as you said, technology stocks, entertainment streaming, e-commerce, to COVID losers or cyclical stocks as financials, industrials, materials, retail, airlines, among others. Now here the question is if you think that this rotation has already happened, or it is a space to continue allocating to these sectors that are lagged.
No, so thanks for that. So the rotation has definitely started. When we look at what the Russell has appreciated over the last month or so, I mean, there's definitely money moving in to the strategy, but we really feel that there is a large amount of appreciation that can still happen across the entire, I guess, sector, mid-cap. A lot of the industrials really have not come back. A lot of the consumer discretionary names have not come back, and so we definitely feel that there is still a lot of room for that to run.
Okay. The second question that we received here is regarding the results of the U.S. elections. What are your first impressions? Which are the main policies to be implemented, and which sectors could be benefited and harmed?
So the election, is it over the election? I don't know. Is
yes, regarding the result of the election, no? the divided Congress. Yes, we have to wait until the 5th of January, right? But
yeah, there's a winner. Yeah, no. So from back to front. So the sectors that will probably do well. I mean, anything that has to do with green energy, infrastructure. Those seem to be things that the Democrats like and will support. I think that when we look at what's flushing out, I mean, an important thing is not maybe what's happened. An important thing is what hasn't happened, and this is key. What hasn't happened is that Joe Biden and the new administration are not caving to the more left-leaning part of the Democratic Party. That's a very important point. It seems to be that most of the people, except for one young lady whose name escapes me, are all people that have been in politics and have been around Washington for a long period of time. They tend to be more moderate. They tend to be more conciliatory. They tend to be less aggressive as on the whole. And to your point in terms of when the election will be over, and to the previous point in terms of the more left-leaning, in Georgia, where the last 2 Senate races will be defined on June 5th, one of the Democratic contenders, is actually slated to lose because he is a big supporter of Bernie Sanders. So we've seen how far the party has moved, and that's something that's extremely, extremely important. And why is it important? Because that will make sure that Joe Biden will pursue, or the government will pursue, initiatives that will be good more across the board than just driving the political agenda. Case in point, another relief package seems like we'll get through now, bipartisan, another $1 trillion, which is a good thing. And then in terms of his cabinet choices, I think the number one thing, first impression that's good, Janet Yellen, not very exciting, but very solid, very firm, lots of experience, knows everybody, and everybody respects her. Very important for Secretary of Treasury.
Okay, thank you. And the last question that we received is regarding fixed income. As you said, yields have come to minimums never seen. So it will be difficult to have a decent income from this asset class. So which are the recommendations to generate income in this environment?
So we look at, obviously fixed income, depending on the risk appetite, we can go down a little bit and increase tenor and increase duration. But not always the right thing to do, because right now we have to go down several notches to go back to where we were maybe 6 or 8 months ago. What we're looking at to generate income, on the one hand, on the equity side, we look at dividend paying stocks, where today we have names, some European names that are paying dividends multiples of what their bonds are paying. So that's something that we find very interesting, and those can be accessed in a variety of different ways, either directly through stocks or through funds or whatever. But also something that we've been exploiting has been short volatility structures on the equity side. So selling volatility either through structured products or through listed options, and that premium, and using that premium as an income base. Individual option sales may be not ideal for everybody, but structured products a very good way to access, very conservatively structured. We've seen clients take the fixed income names that they like, move into a structured product where they have a very large protection until something happens to their equity piece, 50% or 40%, but getting coupons that are, again, multiples of what the equivalent bond is paying on the debt side. Okay,
thank you very much. Okay, we are arriving at the end of the webinar because of the time. So thank you very much, Matias. Thank you very much, Gustavo. Also, Alessandra Martins, that is not here, but she helped us to coordinate the webinar. Thank you very much for all the participants. I think the message is very clear. So for the first part, stay invested is very important to get better returns. And the message from Matias is that we expect a next year with hope. Now with the vaccines, the markets will continue to recover. And so, well, we can have hopefully a better year than this really special year. So thank you very much, Matias. Thank you very much, Gustavo. And well, if anyone has any other question, you can send us by email, and we will be glad to answer that.